Hey everyone, welcome to The Explainer. Let's just dive right in, shall we? Because right now, literally as we speak, there is a silent villain quietly attacking your hard-earned savings. It's invisible, it is completely relentless, and it's called inflation. And honestly, if you aren't actively fighting back against it, you're slowly but surely losing your wealth.
Let me put this into perspective for you. Back in 1913, a gallon of milk would set you back maybe 36 cents. Fast forward a century to 2013, and that exact same gallon jumped to $3.53. That is nearly a 10x increase. No way, right? But why does this happen? Well, most countries aim for an annual inflation rate of about 2 to 2.5%. This means the cash you have just sitting safely in a standard bank savings account is actually becoming a massive problem over time. Every single year, that money just loses a percentage of its purchasing power.
So what does this all mean? It means we have to find a direct solution to this wealth-killing problem. And the answer is pretty simple: investing. The whole idea of investing is using your money to make more money, specifically so you can outpace and beat that rate of inflation. You literally can't just save your way to long-term wealth. You've got to put your money to work. And today, we're going to demystify one of the most accessible and effective ways to do exactly that: the stock market.
All right, Section 1, the fruit market analogy, demystifying the exchange. Now, Wall Street can seem absolutely intimidating. I know. We see all those chaotic numbers, the red and green flashing lines, and it feels completely overwhelming. But I promise you, we are going to completely remove that intimidation factor right now.
Think about your local economy. If you go to a fruit market, you're simply there to buy or sell fruit, and you pick a specific local stall to buy from. Well, a stock exchange is fundamentally the exact same thing. Instead of buying and selling fruit, you're buying and selling stocks, which are just fractional pieces of ownership in a business. And instead of picking a local fruit stall in the corner, you're choosing to trade your shares on a massive public platform, like the New York Stock Exchange or the NASDAQ. It's really just a market, a place where things are bought and sold.
But if you think about it, that naturally brings up a pretty core question. Why sell shares in the first place? Why on earth would a successful business owner chop up their own company and sell pieces of it to absolute strangers? It's a great question, and it's honestly the key to understanding Wall Street. Let's look at it like this. Imagine you own a massively successful local bakery. Your cakes are to die for, the line is out the door, and you know it's time to expand. You want to open new chains, hire more staff, run big marketing campaigns, but you need capital, money, to do that. Now you could go to a bank, but that means taking on massive loans and getting strapped with high interest payments, which is super risky. Instead, you choose the alternative, raising capital by issuing public shares. You decide to have an IPO, an initial public offering. The total number of shares you issue to the public is called the float. So basically, thousands of everyday people give you the money you need to grow your bakery safely, and in return, they get to own a tiny slice of your future success. Pretty cool, right? Moving on to Section 2, how stock trading works, the mechanics. So now that we know why companies list their shares, let's dive into the actual mechanics of how a retail investor like you or me buys a piece of it.
First things first, you need a stockbroker. The broker is just the middleman between you and that massive stock exchange. Now, when we think of brokers, we usually picture guys in tailored suits standing on a chaotic trading floor, shouting over each other, waving paper tickets. But thanks to technology, that physical chaos is mostly gone. Today, your middleman is almost entirely a quiet, hyper-fast computer algorithm, and you just interact with it through a website or an app right on your phone.
Now, when you open your digital broker app to place an order, you have to tell them exactly which company's fruit stall you want to buy from. You do this using ticker symbols. A ticker symbol is just an abbreviated code used to represent a specific public company. For example, if you want a piece of Apple, you type in AAPL. Amazon is AMZN. Tesla is TSLA. A super quick web search will easily tell you the ticker symbol for literally any public company out there.
It really helps to visualize the stock market as one massive, continuous auction with millions of buyers and sellers trying to match up. When placing an order, you've got two main options. First is a market order. This is straightforward. You're telling your broker to buy or sell at whatever price is currently available right this very second. The catch? Because prices fluctuate constantly based on supply and demand, the exact price might jump slightly between the second you hit buy and the second the trade actually executes. On the flip side, we have a limit order. This is where you set a strict reserve price to sell or a maximum highest bid you're willing to pay to buy. You won't pay a single penny more. But the risk here is that if the stock never reaches your price, your order might just never get filled.
All right, Section 3, winning the long game, escaping unpredictability. We really need to talk strategy here, because share prices fluctuate all the time. Tomorrow, a company might release a bad product, a CEO might step down, or government policies could shift. Short-term trading based on that daily news cycle, it's incredibly unpredictable.
It takes massive time, energy, and stress to get right.
So how do you escape that unpredictability? Well, legendary billionaire investor Warren Buffett perfectly outlines a solution with his value investing philosophy. He says to look over a company's fundamentals, their assets, liabilities, and book value, and invest in undervalued companies. He plays the long game. For everyday retail investors with full-time jobs, buying shares in fundamentally strong companies and just holding on to them for years, ignoring the daily noise, is a vastly safer and far less stressful approach.
But maybe you're sitting there thinking, I definitely do not have the time to research hundreds of balance sheets. I totally get it. And that beautifully leads us to the ultimate tool for passive investing, the S&P 500 ETF. An ETF stands for Exchange Traded Fund. Instead of buying just one company, you buy a single share of this fund, and it acts like a giant basket holding the top 500 biggest companies in the US. Instantly, your money's diversified. And the absolute best part? It's self-cleansing. If a company drops out of the top 500, the fund automatically swaps them out for a new one without you lifting a finger.
But as we embrace this long-term strategy, let's make sure we set some realistic expectations. You should really expect a 6 to 10% average annual return. Look, while you might see flashy promises online about doubling your money overnight, a 6 to 10% annual return is incredibly powerful over time. Investing is a game of immense patience, not a get-rich-quick scheme. Earning an average of 6 to 10% a year steadily over a lifetime is how true sustainable wealth is built. It fundamentally outperforms that 2% inflation rate we warned you about at the very beginning.
Which brings us to Section 4, your step-by-step investing plan. Start today. We've covered the what, the why, and the mechanics. Now it's time to empower you to put this whole thing into practice.
Here is your concrete 4-step action plan to get started today. Step 1, pick a broker. A quick web search will show you reputable platforms in your area. Places like Vanguard, Robinhood, Trading 212, you name it. Step 2, buy the dip and choose an ETF. Human emotion makes us want to buy when prices are soaring out of the fear of missing out, but the reality is buying when the market temporarily dips is where the money is actually made. Target those broad ETFs for safety. Step 3, invest roughly 10% of your earnings every single month. Make it a habit. Set it and forget it for 10 to 20 years. And finally, Step 4, arguably the most crucial rule of all, don't panic sell. If you're investing for the long term, you're going to see peaks and troughs. Expect them. Ignore them.
And that leads me to a final provocative thought to leave you with. You haven't actually lost money until you sell. So what are you holding on to? Remember, a dip in your portfolio's value is purely on paper until you click that sell button and literally lock in the loss. If you've invested in solid, diversified assets for the long haul, patience is your absolute greatest advantage. So let your money go to work, beat inflation, and build your future. Thanks for exploring this topic with me, and keep learning.